Hey traders, Raghee here, and in this free recap video for Friday the 7th, non-farm payroll Friday, we're going to go over that projected low entry that we've been talking about for weeks in the recap and premium videos. In fact, we talked a lot about this yesterday in the webinar. And in case you missed the webinar, you can check it out over at simplertrading.co/exits-replay. This is the replay of last night's Big Exits ESP webinar, the secrets behind having an exits first mindset and how that helps you get the best entries and control risk in a way that's really unparalleled in anything that I've done in my trading career. Let me talk you through what happened with NFP today, because it's a perfect example of this particular strategy. And I love recent examples, and so this happened not but 3 hours ago. So we get our 8:30 a.m. Eastern non-farm payroll volatility. Now, we already know what the 68% probability is going to be for the move, and we calculate that. In other words, what we do is we realize that whatever the high is with the candle that started at 8 a.m., we can project a low, and you'll see we projected based upon a plus or minus 14. Now, it really was the projected low that I was interested in, because I'd much rather buy, say, the S&P, and I'd much rather buy the NASDAQ. So you can see here are the calculations on the NAS. By the way, both the S&P and the NAS have been hit pretty hard, because with all the testimony going on Capitol Hill with Google and Facebook and Twitter, traders and investors have expressed their absolute dislike of this, and these markets have been hit very, very hard. So two things were still very clear in my mind. Number one, both the daily time frames of the NASDAQ and the S&P are still intact uptrends. So we want to respect the trend that is. A lot of times traders get very aggressively counter trend. In other words, that's like, dodging the bullet. I'm not Neo from the Matrix, right? So I'd rather be the windshield and not the bug. And that means we have to be able to understand the larger trend. I'm going to always look at the daily for that. So I have a bullish directional bias. And a lot of you know this. We've had a bullish directional bias for months, since end of May, early June. So we project a low. Now, I will say I was not opposed to shorting a price movement range extreme high. I was open to that today. But we did what I prefer seeing. The market sold off. And notice the zone here. We had this zone 10, 15 minutes before, and we waited pretty long before we calculated this. We could have had this far earlier, but 10, 15 minutes before non-farm payroll, we were already talking about this live in the room, that this zone between 74.20 and 73.94 and a quarter was where that sweet spot for exhaustion would be. Now let's talk about the exits first mentality, because what that would mean is this would be the most aggressive, this would mean the most conservative. And quite frankly, anything above that level right there was fair game for a buy. And that's the shift an exits first mentality mindset gives you. In other words, if I know the line in the sand for where this trade is no longer valid is a 73.89 and a quarter stop loss, literally 73.89 and a half would be a valid buy. How low you choose to buy has everything to do with your risk reward ratio. And it's really more about the risk, not the reward. Everyone thinks about the reward, but it really is about the risk. How much can you afford to lose? Where are you comfortable building the position? For some traders, they jumped in at 74.20. Others waited till about 74.10. Others waited till 74 even. I think a couple folks actually grabbed 73. I think someone even said they grabbed 73.95 on this low, which was wow, right? They grabbed 73.95, which was the lower end of the projected low that we use with the PMR calculations, that formula that I talk about to buy these in the morning. A couple folks told me they got 95, which is fantastic. And that's how we got in this morning. The catalyst was non-farm payroll. We knew why there was going to be an increase in volatility. The calculation, the formula, was the PMR projected low, which is one of many formulas that I use for day trading, options trading, future stocks ETF. So this was one of them. And we looked to enter on the one market that actually reached the level. Was I open across multiple markets? Absolutely. We were waiting for the S&P too. It just fell shy. And the Dow never even got close. So it was really not so much a choice to go with the NASDAQ, but quite frankly, a lack of options. But it met the criteria, and the risk was absolutely controllable and definable. So we knew where we wanted to get in based upon our preference or how much latitude individually we were willing to give the NQ. So that kind of mindset appeals to you because not every entry is one size fits all. So what I want to be able to show you all is how you can go with that exits first mindset and build entries based upon how you're going to exit the market. Check out this replay. It's completely free. It's going to walk you through a lot of examples, not just in futures and day trading, but stocks, options, end of day crude. I do this across every market because the psychology of these formulas apply to every single market and any time frame because it's just simple arithmetic and probabilities. Have a terrific weekend. I'll see you in the next update.